Hello everybody, my name is Scott Kelly. I'm the Australian CEO of Real Asset Management. REP is a ticker for the RAM Essential Services Property Fund, which is an ASX listed REIT managed by Real Asset Management. We are a fully independent wealth and asset management business focused on three areas, being real estate, credit, and to some extent private equity. We manage over $4 billion of assets. More interesting answer is that it's a unique investment vehicle that invests in a combination of 35 high quality defensive essential retail properties, supermarkets, and pure medical properties, private hospitals and medical centres. In doing so, it generates rock solid income that grows ahead of inflation over time. That cash flow is stable due to the fact that we have high occupancy in our assets, 99%. Strong annual inbuilt growth escalators. 90% of the leases are exposed to annual escalators, and the leases are long. The weighted average lease expiry is over 7 years. Additionally, we add value to the portfolio by so-called sweating the assets to improve them and expand them over time. And this adds capital growth into the mix for our investors. Listed real estate in Australia is dominated by office and what you might describe as the wrong sort of retail. About 80% of the market are those two sectors, in fact. So this vehicle also offers investors a rare chance to invest in scarce assets, including medical, in a listed environment. It's property, so it's not rocket science. It comes down to three things. Firstly, we look for well-priced assets to buy that help us to achieve what I've just described. It's important not to overpay, and our track record of buying assets in competitive markets points to a very strong capital discipline. For instance, over the course of 14 months, we bought 21 medical assets in a very tight market at an average yield of 5.6 at a time when others were doing deals at yields of 4%. Secondly, we look to enhance those income streams from those assets and also increase the value of them with activities such as releasing, repositioning, aesthetically improving them to get better rents, longer leases, better tenants, and better terms from those tenants. This could also include modifying or expanding the assets to get more lettable space. We summarize these endeavors as value add activities, and we are currently diligently working through $200 million of these type of opportunities and projects that will take us up to 3 years. The result is organic growth, both of income and capital. Thirdly, we trade the portfolio. We're constantly looking to recycle the capital by selling assets where we see limited upside because we've extracted as much value from them as possible in favor of those assets where we feel we can add more value. We did this just a few months after listing earlier this year, and we're looking to do far more. What are the upcoming catalysts? Well, we look at that from two perspectives, from the viewpoint of the underlying portfolio, the assets, and how they're being traded on the listed environment. In terms of the portfolio itself, demand for medical properties is driven by strong demographic and social trends, such as an aging population and an increased focus on preventative healthcare. We are spending more money on healthcare than ever, both at a personal level and also at a government level. Similarly, there are supportive trends in essential convenience neighborhood retail, with a shift in consumer preferences to shopping locally, fueled by things such as working from home. In terms of the listed space and the REIT sector in particular, the macroeconomic environment needs to change. When we start to price in the fact that interest rates and inflation will at first plateau and then start to price in the fact that rates will start being reduced maybe at the back end of next year, then we'll see a big catalyst for interest rate sensitive stocks such as REITs to move up. Markets typically start doing that around 9 months ahead of the actual rate move, so it's probably not too far off. Our stock could rise over 30% before it gets back to fair value. By fair value, I mean the value of the underlying assets in the portfolio. Additionally, first movers will be able to lock in an amazing yield. Our REIT is currently yielding over 8.5%, which is crazy for such defensive cash flows and indicative of the sentiment around equity markets right now. That's a compelling combination in my view. Then how do we create shareholder value? We create shareholder value through the prudent acquisition and management of a diverse range of 35 high quality defensive assets in a portfolio that generates both very attractive income and capital growth over time. These assets are either pure medical, private hospitals and medical centres, or essential retail, supermarkets and neighbourhood centres. The growth comes from two sources: through baked in annual escalators written into the leases, and through so-called sweating the assets, which means improving them with low-risk projects, repositioning them, releasing them, and so on, to generate added value. The fund also gives investors access to scarce assets, especially the medical side of the portfolio. Less than 1% of listed real estate in Australia is medical. Finally, by being a prudent steward of capital, and for instance, managing costs, including interest rate costs, which is very topical, and being disciplined with how we deploy investors' capital.